Good morning, everybody. Welcome to today's 1 million by 1 million strategy roundtable for entrepreneurs. 1 million by 1 million, as you know, is the first and only global virtual accelerator for technology startups. And we take pride in being inclusive. We are not focused completely on venture funded startups. We do our share of VC funded startups, but we also categorically support bootstrapped entrepreneurship, and that's been the case right from when we started. So that was the whole mission of 1M is to support whom nobody else wants to support. So the other 99%, as we call it. This is our 680th free mentoring roundtable. This started back in 2008 and has been going on and on for a long time. And we are here almost every Thursday with some exceptions, but probably in any given year out of 52 Thursdays, we are here 48. So pretty strong show up rate. We are going to start today's session with a conversation with Mark Phillips, founder and managing partner of 1Tribes Venture out of Chicago. Mark, welcome. I'm looking forward to getting to know you.
It's wonderful to be here, Sramana. Thanks for having me.
So Mark, tell us a little bit about 1Tribes Ventures. What is your fund size, investment thesis, just an overview, and then we'll dive into AI, which is the current seed case.
Yes. Well, I really appreciate how you opened the conversation here, because we see the world a bit differently too. I think in order to adequately describe what we do, if I may, Sramana, I'd love to just share a brief background of my history.
Of course.
I'm based here in Chicago. I'm trained as a strategy consultant. I worked at Accenture for years. And then I went to business school, and while there, I started my own company. And I was in Chicago building a health tech company called Diasense. It was a hardware device designed to help type 1 diabetics better and more passively measure blood sugar. And I drank all the Kool-Aid of kind of the coastal mindset of venture capital. And I think one of the things that I hope every entrepreneur on this call listens to is you have to build the company that is right for you. Yes. And I think what I was trying to do, Sramana, is I was trying to build a company that was right for everybody else. And it will come as no surprise to you that that company, whether it was spectacular or not, it failed. We got leapfrogged by a better product. We ran out of cash. Morale completely, crumbled around us. And ultimately that business was shut down. And I share that story of failure because it was failure, because it has been such a seminal moment in my life. I went through a pretty startling identity crisis because of that, Sramana. Yeah. Just dealing with what is my value? Who am I if I'm not building this company? And even as a person of faith, that was a really important process for me to go through. And I look back on that failure with a ton of gratitude, because I think it helped me understand who I am, what I care about, and what's the work that I want to do in this world. And so we started 1Tribes with that backdrop of, yes, business outcomes are great. I am a capitalist at heart. I want everyone on this call to make plenty of money and have a lot of financial success. But there's another half to the equation beyond the business outcome. We call it the founder outcome. What does the mental, emotional, physical, spiritual health of that entrepreneur look like when they have either shut down the business or sold it to some type of competitor or strategic buyout? When you exit that company, what is the quality of the things in your life that are most important to you? And I think the challenge that as entrepreneurs we run into is because we care so much about what we do, because the business we are building is like a child to us. We convince ourselves that we can put things like our mental health, we can put things like our relationships with family and with friends, we can put things like our religion or our faith to the side and say those will be there in 10 years. But the problem is they will not. That is not true. Yeah. And so as a firm, we exist to be the firm where capital and care are focused on the founder. We make an allocation of, we call it our founder resilience commitment. 2% of every dollar we invest goes directly to the entrepreneur for them to put towards their resilience. That's coaching, it's counseling, it's leadership development, it's organizational health, and that's non-dilutive capital. So if we put $1 million into a company, we have a $20,000 grant that comes from our fund and goes directly to that entrepreneur. We're so excited about that. It's so amazing to have a base of investors, limited partners, as we call them, who are willing to allow us to use the capital in that way. And it really informs the decisions we make as we think about what are the type of companies, and more specifically, Sramana, who are the founders that we want to be partnered with. So that's an important backdrop. You can tell I care a lot about it because it's a very personal experience for me. And so we now exist. Yeah, please.
Let me just comment on what you said. I think it's the problem with the venture capital model that we have arrived at this point over the last, let's say, 30 years, is that it is all consuming. And the investors expect the entrepreneur to put everything aside except for making the venture a success, and that success has to be success that makes the investors money.
Yes.
Otherwise, it's not considered a success.
Yes.
If the investors don't make money, the founder's not going to make any money at all. So 7 years, 10 years of life can end up in nothing by way of wealth creation and what is determined as success.
Yes.
So that's a very depressing outcome. That's a very depressing scenario. But I think the balance of mental health, balance of life, family, relationship, it all goes by the wayside.
Indeed it does. And, I don't want anyone to hear this and think that we're taking the easy way out, Sramana. I think we're simply addressing the facts. Harvard had a study that they did, which has been cited many times over now, where they found that 63% of startup failure, the founder will attribute that failure to people-related issues. So this isn't just a nice to have. This isn't me patting myself on the back, trying to make myself feel better because I'm helping people. I am, and I'm proud of it. But it's also, in our estimation as a firm and as an investor, a strategy. It's a risk mitigating strategy to say, hey, maybe 2 or 3 companies in our portfolio would have failed because of co-founder conflict. But because of our mindset, because of the thesis we bring to our partnership, and because of the founder resilience commitment that we've made, that co-founder conflict is avoided. It's a value creation mechanism, and it's been amazing to see it really come to life throughout our portfolio.
So I hear you. Now let me ask you for the more traditional part of your business, which is venture capital.
Indeed.
Venture capital, you're in the business of venture capital to make money. You're
Indeed.
not in the business of venture capital to not make money. So now tell me, what is your fund's investment thesis?
Indeed. I appreciate that. We are here to make money. And if we do not make money, then investors stop giving us their money and we cease to have a business, as you understand full well, Sramana. Our thesis is indeed a little bit different. So it follows in suit with everything that I've just shared. I think the why, I hope, is very clear to you and to those that are listening. And I think if we were to suggest, again, we're a Midwest-based firm. Venture capital in the Midwest is still a little bit of an oxymoron, if I'm being completely honest. And so I think a lot of Midwest and non-coastal VCs have tried to play the same game. And when you see Andreessen Horowitz announcing just yesterday that they're raising a $20 billion fund to allocate into, early stage AI, if we try to play the same game as Andreessen, if we're simply scouts and getting them onto our cap table, we do not have the same return profile. We are not looking for the same types of deals. And so as you started this call, Sramana, you alluded to this idea of we support diversity in terms of the way that people think about the way they want to build their business. And we feel the exact same way. When we look at the companies we're targeting, there's really 3 things that I would point out to you. The first and foremost is we are very price sensitive investors. I think as an asset class, we have lost sight of the fact that price matters. And many of these large funds are pumping 20s and 30s of millions of dollars into early stage startups who might not even have a real go-to-market strategy in place yet. But when you do that, what you do is you place, I think, unrealistic expectations on the back of the entrepreneurs who are taking that money. Because for all the founders listening, you have to understand each of these firms has an underwriting mechanism that they're operating within, right? So if you are taking $20 million on a $50 million pre-money valuation, well, that firm is at least underwriting your performance to 10x, probably something closer to 20 to 30x. And so all of a sudden, the only thing, to your point, Sramana, that looks like success to that VC is a unicorn outcome.
Yeah, most VCs, and certainly Andreessen Horowitz, are operating with a unicorn chasing mindset. And Andreessen Horowitz, this particular fundraise is absurd, because to give returns to limited partners on a $20 billion fund,
it makes no sense.
It does not make any sense, because there aren't enough exits to give that
Correct.
level of return in one fund, because that's assuming that the entire industry's returns are going to go to Andreessen Horowitz.
One firm. Yeah. I think I saw a stat that if you do the math, they need to generate something to the tune of $600 billion.
$640 million.
Was it 640? Okay. Which is more than the last 100 IPOs in the tech industry. It's no longer, to the founders listening, you really have to get what the VC that's giving you money wants from you. And what Andreessen is really drawing the line in the sand is like unicorn isn't enough for them anymore. Right. So now they've got the word decacorn and they've got centacorn, right? $100 billion outcome.
And these speculative investments don't really, they end up, these unicorn chasing speculation ends up in unicorpses very often, right?
Indeed.
Because you're raising, as you gave the numbers, $20 million at a $50 million valuation. Well, it's not going to be a $50 million valuation. That's too much dilution in Series A. If you're doing a $20 million Series A, that's too much dilution. So that doesn't really work. If you're raising $20 million on a, let's say, $80 million valuation with no real goods, right? You don't have the MRR or the ARR to support any of this. It's all speculative. Then you have to backfill that valuation before the next round of financing. Otherwise, you're going to have a down round.
That's it.
So
That's it.
This is a terrible situation. So anybody who's listening and who's thinking about, unicorn chasing, blah, 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 please the fact that this is not to your advantage.
No, it's not. It's not. That's such wise commentary, Sramana. And that's, so you've asked me a direct question, and now I need to give you a direct answer. What are we doing? We're running as quickly as we can to the other end of the barbell. I think venture is quickly I think the venture capital ecosystem is going to become a barbell approach. The reason Andreessen exists is because there's these pension funds, there's these endowments that have massive amounts of capital that they need to put to work. And they want to park it somewhere, and they want to have a name brand associated with where they put that money. And so these firms are not going to stop raising these massive funds. But I think the thing that's going to emerge over the course of the next, 10 years is the proliferation of truly value additive emerging funds that are much smaller, right? Because when you have so we just closed, last week we closed our second fund. It was a $46 million vehicle. We had targeted 40 million. We oversubscribed by 6. We're thrilled to have this new capital in market, and we're actively deploying that money. And so as we look at the kind of businesses we want to find, we are focused on entrepreneurs that are generally located outside of the coasts. We want founders that are based in tier 2. We are a domestic investor, so we're really focused on North America at this point. We do hope to expand into the future. When we look at these entrepreneurs, we want folks that are, based in a tier 2 or tier 3 geography. So that's Chicago, Atlanta, Austin, Texas, Denver, Colorado. You get the idea, right? These ecosystems where there's less hype, I suppose, is what I would describe it as. And what we've really experienced, Ramana, is what I would call geographic price arbitrage. Simply because a company is building in Nashville, Tennessee, as opposed to Silicon Valley, as investors, I think we're getting something probably close to 2 to 2.5 times discount at the seed stage. So that's the first component. The second is what I would describe as capital efficiency. I think we are really subscribing to this idea of seed strapping, which many founders have probably read about over the course of the last 6 months. The idea of taking a moderately sized seed round at a reasonable valuation, using that seed capital to drive to cash flow break even, and ultimately making a strategic decision about whether they raise future capital moving forward or using the profitability of the company to grow their organization. Those are the kinds of companies that we really want to participate in. And from a sector, we are actually very agnostic. We will look at anything if it kind of fits those 2 criteria. And then the last piece I would describe is, I think at our core, what we really are is leadership investors. Everything I shared at the top of our conversation, those are the passions that our team holds. The idea that the leader is the only thing within the organization that needs to grow faster than the company is something that we really share with our teams and with our portfolios on a regular basis. And so if you give me an entrepreneur who has a unique right to win in the space, maybe they've worked in the supply chain industry for 25 years, they've seen a problem, they now know how to solve it, and they're stepping out and want to run a very capital efficient business. That is the type of entrepreneur, and that's the type of startup that we at 11 Tribes get really excited about backing.
What size checks do you write?
We are out of Fund 2, we're writing a $1 to $1.5 million check into 25 to 30 portfolio companies over the course of the next 2 to 3 years.
Okay.
Generally, the rounds we're participating in are priced somewhere between probably $10 and $15 million pre-money. These are post-revenue companies by and large, so we're not doing a ton of pre-revenue investing at this juncture. And they're raising anywhere from $2 to $3 million of capital in that round.
Okay. So when you say post-revenue, what kind of revenue level are you looking for to invest in?
The strike zone for us is $500,000 to $2 million of revenue. And we're happy for that to be annualized. I mean, we'd prefer it to be realized, but I realize now ARR has really become a MRR times 12, as opposed to, hey, this is actually recurring revenue. But that's an annualized number of $500,000 to $2 million of revenue over the course of the last 12 months.
And you said you're sector agnostic, so this is not focusing on anything. You're willing to invest in anything you want.
We are. I mean, the best performing company in Fund 1, so this is Fund 2. Fund 1 was an $11 million vehicle. The best performing company was a direct-to-consumer functional mushroom coffee called Rise. Maybe a few folks on the call have tried it, RYZE. They've become a very dominant player in the mushroom category. Not a space that we had a ton of conviction in, but we met founders. The gentleman who runs it is a guy named Andre Rashad. Andre and Rashad run the company, and they're classmates from Harvard. He worked at Kraft Foods, felt like they needed a mushroom category. When they said that they didn't think that was the right strategic initiative, he moved home. He bootstrapped the business. He got it to $1 million of revenue very, very quickly. And when we looked at that opportunity, we saw someone who had incredible leadership potential. The business has gone on to perform exceptionally well. But I use that as an example, Sramana, of like, we're not just enterprise SaaS investors, right? We don't need everything to kind of fit into a square peg round hole situation. If you've got a great CPG product, if you've got a great piece of hardware that we think you have a unique right to win within that space, it's absolutely an opportunity that we will consider.
Have you done a hardware investment?
We have one in Fund 1. It's a medical hardware device called BrainSpace, and it's helping solve a very real problem of relieving cranial pressure in hospitalized trauma patients.
And what is the go-to-market strategy? Through hospitals?
Yeah, directly through hospitals. And so they're months away from FDA approval. It does require FDA approval, but they've got a backlog of numerous hospital administrators and executives that want to use the product. The process of
pre-revenue, if it's FDA pending, how can it be post-revenue?
Yeah, so this was a Fund 1 investment. So that was out of Fund 1. And as I talk about us investing in post-revenue, that is a Fund 2 strategy for us. Fund 1 was a 2021 vintage. And as I kind of started at the top and said, price has always been very important to us. As we allocated out of Fund 1, we didn't budge on price. What we moved on was the traction of the business itself. So Fund 1 has a few more pre-seed investments, but Fund 2, given where the market is today, will be an exclusively post-revenue post-revenue investment strategy.
So Mark, talk to us a little bit about, so we are a tech and tech-enabled services accelerator. We don't do CPG, we don't do medical devices. We actually only do software, and we would do hardware, software, but it's all within the information technology domain. We would do e-commerce within CPG. If you have a CPG product that is a primarily e-commerce product or hybrid, that we would do. So tell me a little bit about, in Fund 2, what are you expecting to see? And I'm sure you have some sort of a pipeline and deal flow that's already built up.
Yeah.
As you are starting to divest your second fund.
Yes.
What is happening in your, in the geographies where you are interested in? Tell us more about what's happening in the tech-enabled services world.
Yeah. Thanks for aligning on that. That's helpful. And to be clear, the opportunistic things are probably 20% of the portfolio. There's still a huge 70 to 80% of what we're doing that are absolutely tech and SaaS enabled. And so that's an area we spend a lot of time discussing. We got to start at the top of the call by discussing the role of artificial intelligence. We will not invest in what I would describe as sort of the AI wrappers or even any of the underlying large language models, right? I think all of that fundamentally, in our estimation, Sramana, is a race to the bottom. I think when DeepSeek came out from China and we looked at the performance of it, I think it became very clear that the moat of these large language models was not terribly significant. And I think the other challenge from an investor point of view is we just have no idea what the pace of change is going to look like.
Not only that kind of business is not a small fund game.
Indeed.
That is a very large, that is Andreessen Horowitz's game.
You're spot on. And the theme here, that's spot on. You nailed it. And the theme here is, again, the mistake I made building my first company was I was trying to build it for somebody else. And who we're trying to be as 11 Tribes is the investors that is true to who we are. And I think that's a really important thing that anyone building a company needs to understand for themselves. back to your question directly, I think one of the biggest things that we're really appreciating is that as we're investing out of this 2024 vintage, software CEOs are really becoming AI natives, right? And so it's not a question of how you're using AI and in what ways it's being integrated into your business. That's a given, right? It's a question of how are you using that AI enablement to create some prior or previously unattainable aspect of your company that is going to either create a better go-to-market strategy, a better customer experience, or a better retention strategy for the customers that you have already retained. And so it's no longer a question of like, how are you using AI? Are you using AI? Really, the generation of entrepreneurs that we are starting to see have been building for the last 2 years since the advent of ChatGPT, and they have become very proficient at integrating AI directly into the processes of what they're doing. So that's the first kind of component piece. I imagine you might have a comment there, so let me pause before I kind of talk about some of the other trends. Are you seeing something similar?
Well, the way we look at AI is different. Where you would find venture fundable AI companies is something I look at differently, and many of my colleagues here look at differently. In that most of them are bypassing the infrastructure layer where there's these large language models or very large data centers and so on and so forth, which is basically a money game, right? Money to scale game. And that's happening in the hands of big tech mostly, and companies like OpenAI and Anthropic. But most small fund investors are looking at the application layer where you can make use of all these different layers that are already in place. And the differentiating factor in that application layer is domain knowledge.
That's so well said. Yes.
You're doing something in manufacturing, then you need deep manufacturing domain knowledge to build something interesting. If you're doing something in pharmaceutical, you need deep domain knowledge there. So it's people, you're talking about founders. The founders that are prized are founders who bring that kind of deep domain knowledge with which to build something differentiated.
Yeah, you took the words right out of my mouth. I think as we look at our Fund 2 portfolio, we've actually got 8 companies in the portfolio today. And I think of the 8, 6 of them are first-time founders that are coming from industry. Okay. So one's coming from the hospitality space. One's coming from the hospitality space. One's coming from the supply chain space. Another spent a career in the regional bank and credit union world, and now he's building something that is AI native, AI enabled to help those credit unions better process business formation, wills, and trusts for some of their clientele. And so each and every one has this deep and abiding industry expertise that is allowing them to quickly and really efficiently solve a pain point and generate revenue for their customers, which brings me to really the second point that we're seeing. And again, I think there is going to, I'll be curious how you react to this one, given where we are geographically located. We are seeing a really quick shift away from, at least in the founders we're speaking with, away from this growth at all cost mentality to a capital efficient, cash flow break even. I want to control maximum optionality for my business.
Good.
And I think the question that begs for us, Ramana, as a fund is you can't have it both ways. You can't have a very, very low batting average and companies that are choosing to go into this cash flow positive, sort of more sustainable, profitable growth mechanism, largely because that second component I just alluded to, we have to be honest as investors, we are ultimately capping the upside, the overall upside of the business when we encourage them to take less capital. And so what we're building into our fund profile and into our fund modeling is actually a higher batting average. What we're seeing in Fund 1 today is we believe we can achieve a 30 to 40% success rate across the portfolio, underwriting the growth of these companies to an enterprise value of $100 to $150 million at exit. And so I've had folks who have said, hey, that's not venture. And I respect that pushback. It is definitely something different than what traditional venture has looked like. But again,
there's a very, people who know that most exits in software are less than $50 million exits.
Exactly.
So to play that game, to make money for everybody, including investors and entrepreneurs, to make money with a $50 million, under $50 million exit, you have to build very capital efficiently and get to, 5 million in revenue so that you can But the trick there, though, still, to get that exit, there are two things you have to think about. One is you need still velocity.
Yes.
So how do you play that game of being very capital efficient, but still maintaining a certain amount of velocity that will make the company worthy of an exit? That is the tricky part of playing the game that you're trying to play. There are many, I know a lot of investors who are playing that game. I've, brought them on here many times.
Sure.
If you go to Udemy, I have a course called Alternatives to Venture, Unicorn Chasing Ventures.
Yeah, that's good.
So that's that category.
Yeah.
But you have to be mindful about the exit strategy and the velocity part.
I don't think enough people talk about what you just shared there, the idea that the majority of software exits occurring, in that sub 50, sub $100 million. The actual statistic is of all M&A activity in North America over the course of the last 10 years, 96% of all exits occur sub $100 million in enterprise value. That's a overwhelming number. And you nailed it, right? So it's that tension between lifestyle business and hypergrowth startup. What does the middle point of that spectrum look like? And those are the types of entrepreneurs, and those are the types of businesses that we're really looking to back. And I think
you're still probably looking for hypergrowth startups, Bob. The reason being that to get an exit, you need growth. Otherwise, the people acquiring are not going to buy the startup. But you don't invest gobs of money in building the channel. You use somebody else's channel to scale, but you get it up to a point where using somebody else's channel is going to grow really fast.
That's right.
That is the game you're playing.
That's right. And you're spot on. We are looking for I'd say we're looking for hypergrowth founders and who are building businesses that have the potential, but we aren't injecting the rocket fuel that is the 10 or $20 million, seed check that's going to place, like I had described, the unrealistic expectations on the back of the founder.
Yeah, that kills it. If you put $10-20 million out of the gate, then you cannot play this game.
No, that's it. And so it takes a strong alignment. It takes a lot of conversations. We actually have developed a handshake agreement. It's a one-page document that we've described and articulated as best as we can what we're talking about here, right? This tension between lifestyle business and hypergrowth mindset. What does it look like in the middle? And we actually ask each of the founders we invest with to sign it. And interestingly enough, Sramana, as we've used that document, we shared at about the 80% point of our diligence process. It's actually killed a couple deals. We send it to a founder, they read it, and they respectfully say, this is not the kind of business I'm looking to build. I want to go raise Andreessen Horowitz capital. I want to take this thing to $1 billion. And we shake their hand. We wish them all the best. It comes back to the whole theme, I think, of this conversation, which is build the business that's right for you.
Yes.
I don't have any judgment against those people. I wish them all the best.
Your identity is tied to building a unicorn and being an Andreessen Horowitz funded entrepreneur, then that's a different track. Indeed.
And it's not wrong. It's not the wrong track. It's just not the track that we're interested in. And I think to answer your question, again, this is kind of my last point. I don't think it's a track that a growing and burgeoning swath of the entrepreneurial ecosystem is interested in. I think a lot of people are thinking more about sustainability, durability, and profitability. And I think we're really excited to be, I feel like, on the front lines from an investor perspective of trying to back those types of businesses and those types of founders.
I'm sure in the category of entrepreneurs you are seeing in the geographies that you're catering to, that is a true statement. And they're benefiting from the fact that the ultralight startup trend is really taking off right now.
It is. I think we could talk about that for some time, Sramana. What does AI mean for all this? And I would contend that I think the barrier to entry of getting a startup off the ground is quickly plummeting to zero. Even product differentiation is very quickly becoming something that is not a competitive advantage. You can code a new product, you can recode some product that already exists in no time at all.
This is the downside of the ultralight startup trend. Is the copycats are going to be absolutely everywhere, and too many copycats makes a venture in a particular segment, makes a company non-venture fundable.
Well, it becomes that's spot on, and I think the moat, the thing that allows them to win, becomes a couple of things, right? I do think leadership and the viability of the team internally is going to become critically important as these teams tend to shrink. I think we're going to see smaller startup teams. I think the community narrative, how are they creating a community in their customer database, right? Do those people who are buying your product feel like they're part of something that's bigger than themselves? And then I think ultimately it comes down to the go-to-market. Do you have a unique niche that allows you, whether it's a channel partnership or otherwise, that allows you to get your product into the hands of customers more quickly and more inexpensively? So those are the things we're largely evaluating as we look at the businesses in these geographies that we're focused on.
My take, if I were you, would be to look at TAMs that are smaller.
Yes.
Because that's going to stay out of the reach of the
That's very insightful.
Traditional VCs. They're going to go for the billion-dollar TAMs. If you can go for a TAM that is a bit smaller and can establish hypergrowth within a smaller TAM that might still score an exit. That's the way I would build your.
That's a really insightful comment. We just did invested in a company called NQS. It's a software platform for trauma departments in hospitals. And there's only one product in the market. It's called ESO. It's a very bad product. And they're the only competitor because the TAM's about $250 million in total. It's a tiny TAM. But we believe that within 18 to 24 months, this founder with his product can capture probably 50 to 60% of the TAM.
There you go. That's the strategy.
And nobody else is there, Sharmana. No one else is there. And so to connect all the dots, this person has spent 20 years. His name's Mark Feinberg. He spent 20 years in trauma. He understands it intimately. He knows why people need what they need solved. And we're so fired up about it. That is such a great comment. It is so counterintuitive, but it comes back to the whole point. Build what's right for you. Build what's right for you. Find the thing that you are gifted at and uniquely equipped to win at. And I think that is when success will follow.
Okay, Mark, let's listen to some pitches.
I would love to.
Folks, before we get started with the pitches, whether you're pitching today or on a later session, we want you to know that we are completely on your side. This is a safe working session. Please do not be defensive. Do not be nervous. Nobody is coming at you to embarrass you or anything. This is going to be a candid conversation. I will tell you, I don't know what Mark will do. I will tell you what I think. I'm not going to sugarcoat. It's not my style. So, but it's for your own good, not for some pleasure that I take by being stupid and aggressive.
Hello.
Can you please mute your line, whoever is making this noise? And then if you disagree with me or with Mark or whoever else is going to be at your session when you're pitching, it's fine. It's your venture. You do whatever the hell you want to do with it. That is the prerogative of an entrepreneur. All right. We're going to start with Pranav from Chennai. Pranav, please unmute your line and tell us what you're doing.
Thanks for this opportunity. And strangely enough, it is our first external pitch other than our internal advisors and team. So
you want to turn your video on?
Sure. So yeah, it's our first external pitch. So yeah, we'll see. I don't know. Maybe a little bit, yes. So it may be adrenaline or nervousness. I don't know. So either of them. So yeah, as the headline says, the name is ETHYX. That's the brand name, and it's we think of it as a social impact startup.
Okay.
Partly because of my personal background, I started my career in climate finance and then moved to private equity with social impact. So I bring a lot of that thinking of ESG metrics into this. So it's a platform. On one end, it allows MSME small companies to borrow money via bill discounting. And on the other hand, it provides patrons or retail investors and high net worth individuals a high yield fixed income yield product that they can invest in, an alternative investment product. Next slide, please. So that's the team. I think Poonam is she's on this conference, but she's like a listener. And that's me. And Ketan is our CTO. We're middle-aged entrepreneurs. We're in our 40s and 50s.
That's fine. That's not a problem.
So yeah, so it's an interesting phase for us.
There is a lot of ageism in the business, but as far as we are concerned, it's perfectly fine to be a middle-aged entrepreneur.
Yes. So yeah, this is just expanding on who the patrons could be and who the MSME companies and they could be MSMEs, they could be merchants, They could be exporters, social and environmental ventures, or micro SaaS or SaaS companies as well. Next slide, please.
So just a second.
Yes.
We are 4 slides into the presentation. Let me try to capture what I've heard. Is this a two-sided marketplace for mid-market or mid-sized companies to raise money? And it's a particular kind of money. It's bill factoring kind of money, right?
That's right. Yeah. So it's bill discounting kind of. It's against an invoice, and it's debt money. It's not like equity.
Okay.
Yeah. So this is a no-brainer. The yields in India are pretty low from a fixed income product, and the Gen Z and the millennials are turning away from fixed deposit. It's so much so that people are, there was a headline in the paper 3 days ago that banks are turning to temples for deposits because the CASA ratios are dropping. So the deposit-led banking is as a theme over, and the banks are slow to adapt to this trend, and that's where gives us an opportunity for us as a fintech to address that.
Now, do you have to operate this as a banking institution or a non-banking institution?
So it's a hybrid entity. So we have a private limited entity that's called TSP, a technical service provider, but we have a non-banking finance company as well. In today's day and age, with India's regulation, if you are operating as a TSP without the backing of an in-house NBFC, it becomes very regulatory claustrophobic, or very, very,
But
it's very difficult.
my question is, can you do your business as a non-banking?
You can. Ultimately, you have to go and partner with the non-banking finance company. So there are people who do this business as a private limited, but they would have to have partnerships with non-banking finance companies.
I see. Okay. Well, regulatory apart, what is the interest rate that you're offering on your platform for the people who are going to be lending on your platform?
So it could be 9% plus. So it can go up depending on the bill, and we'll talk about the kind of vendors. Okay. It will go up 14 to 16% as well. So it changes by the duration of the bill and the kind of vendor that is. As in, typically bills that are supplied, let's say the supplier supplying to Unilever or Coca-Cola, that bill would be at 9, 10, 11%. Whereas the person who is supplying to the supplier of Coca-Cola, that bill gets discounted at a higher rate.
Okay.
But you want to change that narrative a bit, and I'll talk about that a little later. So it's a no-brainer in terms of market size. This 80, I'm sorry, these numbers are a little bit in Indian rupees, but there's basically $98 billion worth of credit gap in the market. But there's almost a similar amount in what they call as unaddressable demand or unaddressable market, and we think we call it deep dive.
That's where you want to go in. So I'll tell you, I'll cut through the chase, Pranav. I've seen a lot of these kinds of businesses. We've had this kind of businesses in the program. The big issue is competition. In India, fintech is big, and this MSM, mid-market lending is one of the biggest categories, and it has been heavily venture funded, heavily, explored. So, what is your understanding of your direct competition? I know the indirect competition is huge.
Sure. For that, Maureen, can we next slide, please? Because then I can jump to even next one, and then maybe we can come back. Even next one. Or maybe it's not here. So, okay, let's stop here a little bit, and I'll talk about the competition, and then later to this slide. So there's a company in the US called Pipe. It's valued fairly, and there's another company called TradeWeb, and there's another one called Brazil New Bank in Latin America. So the valuation drivers and the differentiation come from these three models. One is that we have a secondary market, which is automated, like an electronic trading market for investors to sell their long-term bills to other investors. And that liquidity platform makes a difference. We'll be the first to market with that. Right now, the tech is built, it's closed source, like it feeds into our primary platform, the originating platform. But then we hope to open source it and allow other lenders also to other primary originators to link via API and have a secondary trading potential of their debt book.
And there is validation that this kind of secondary trading on debt happens?
Sorry, could you repeat that, Shamana?
There is validation that this kind of secondary trading on debt happens.
Yeah, so TradeWeb is a company in the US. It's a NASDAQ listed entity. They do listed debt as well and unlisted debt. We don't want to go near listed debt because the regulations require a separate license, and it's the way the regulation.
Validation in India? Is anybody doing this in India?
Not that we know of.
Okay.
Not so essentially they have it, but essentially what happens is, like, if I'm an investor and I want to sell it, ultimately a relationship manager will call me and say, okay, I'll try and help you get somebody to buy this deal. So there's no market maker, there's no quick liquidity, and there's no online trading. You got to rely on the relationship manager.
Unorganized. It's an unorganized sector.
Yes.
Like many things in India. So Pranav's question here, is this a concept stage venture right now?
Yeah, so we are pre-seed, we are pre-revenue, but it's not concept. We have 80% of our tech stack ready. We need to complete debugging it and get some cybersecurity features in, which we haven't started on. We should be ready to launch in about 6 months.
And how are you financing it?
We've self-funded it, both the non-banking finance company and the TSP. So far, we funded ourselves.
2 companies?
Yes, so we have the NBFC in-house as well. So we deploy.
The reason I'm asking you this question is going to be a problem. The company that you're trying to build is going to be not very easy to bootstrap. You're going to need financing. This is not the kind of company that you can easily bootstrap or even seed strap. This is going to require some serious financing. And structurally, all these 2 companies and all this stuff is anathema to VCs. They do not like this kind of stuff. So you better clean up your corporate structure if you want to go out to raise money.
Yeah, so we look for feedback on that. We've been getting mixed feedback. So some people want the TSP to be the holding company. Some people want the NBFC to be the holding company. And some people really want them separate. So ultimately, we've left it in the hands of the.
What is being financed? Which company is going to be financed?
So that's what the capital structure. We left it in the hands of the investors that come in. We are more than accommodative to switch one into a holding entity and make the other one a subsidiary of that.
All right, this is very complex stuff. If you want me to be involved, join the premium program and we'll work on it inside of the program. I have to move to the next. That's your primary question, is it? That
yes.
The structure of the company. Mark, do you have any comment before we move on to the next page?
No, I echo, Sramana, what you had shared. I think this requires a lot of financing, which is not a bad thing, but minimizing complexity is going to be in your best interest.
And the other thing that is going to be helpful is if you can get to some kind of validation, if you can finance the next 6 months, clean everything up and get some transactions to start happening so that you can show that, whatever is proof point in your domain is happening and you're capable of making that happen, that's going to help. But the company, I think, is going to require some financing.
True.
Okay, we can do more Q&A. Let me just go through all the pitches and then we can come back and do more Q&A in a little bit. Dhiraj Pandari, also from India, Delhi. Is Dhiraj here? Maureen, Dhiraj is not here? No show. That's really irritating because I know Maureen turned down other people to give you a slot. This is very irritating and very disrespectful. Dhiraj is not going to get another slot here. Jyotika, also from Delhi, okay? Jyotika, please unmute your line. Where is Jyotika? I saw Jyotika. Oh, Jyotika has left. What? These are really disrespectful people. Henil?
Yes.
Go ahead, Henil.
Yeah. Yes. Good
You
morning.
can turn on your video if you like. You don't have to. You can also just speak.
Hello.
Yes. Go ahead.
Yeah.
Let's get going.
Yeah. Flip forward. Yes. Basically, my idea is a Sangini application, which is mainly from a one type of a community-based application, which are cover a woman's health condition, like a PCOS, pregnancy, postpartum, uh, stress, and wellness management. So they can,
Anil, why are you doing a women's health company? What is the genesis of this project?
yeah. In India, there is 80 million plus women are facing those kind of issues, and
No, I know,
particularly,
I understand the issue, but why are you? Why is this a good fit? So there is, let me back up for a second and explain to you where this question is coming from, and then you can answer it more accurately.
okay.
Anytime you do a venture, you should ask yourself the question, am I the best person to solve this problem? So why is Henil Nardiya the best person to solve this problem?
Yeah, because I have to seen around myself, my mother, my sisters, and my colleagues, my friends. They are facing a lot of their issues. So I have technical skills or people skills. With that, I have to solve this issue. That's why I have to do and create a community so they can share their problem.
Henil, you're going to have a
And
lot of difficulty with this company because you don't firsthand understand the problems. You're not
I have
experiencing these problems. You don't really understand these problems. You're listening to your mother and sisters and so on, but I don't think you have a visceral understanding of these problems.
I have one of my partner. He is helping with uh, this idea.
Okay, what is the product? What are you offering these people? What are you offering these women?
In starting phase, we are offering a community basis or AI personalized chat and consultation, which is a virtual consultation.
By whom? Are you going to hire doctors?
Yes, it's a expert consultation part, so we can tie up with the experts who are in experts in PCOS and pregnancy management or gynec like this.
What is the business model? How are you planning to make money?
So we can introduce first. We are giving a freemium model, and after that successful customer acquisition, we are introduce a premium model, which is
And
basically start.
how do you fund the company? Freemium businesses are incredibly difficult to fund because it doesn't start generating money, and the freemium to, free to premium conversion rates are abysmally low. So you need a lot of capital with which you can bootstrap the company and get it to start generating revenues. And so it's very, very difficult to finance. How are you going to finance that company?
Yeah, so we can tie up with NGOs and make an online webinar or tie up with an influencer like this or government schemes.
I don't think that's how this works. I'm going to refer you to a company that you should study very closely. It's called MIDI Health. It's a company out of Silicon Valley, founded by a very experienced woman from the startup industry called Joanna Strober. It's a female founding team who deeply understood a chapter of a woman's life as it pertains to health challenges, and that is menopause. So Joanna's understanding was that menopause is underserved in the medical community, and women have very specific needs in the menopause phase. And so she built this whole company around menopause, and it is, doctors are part of it, but she operates this as a subscription business model where this menopause service in a telehealth service mode is that woman going through a menopause, post-menopause phase, this woman's primary care physician. So that is a viable business strategy. And in this case, in the case of MIDI Health, it works in the United States because insurance has now, post-COVID, insurance has been covering telehealth. So many things came together for this business model, MIDI Health, to be viable. So my recommendation to you is you are going to need to come up with a particular, if you want to do a women-focused venture, you need to find a particular problem within the venture. If you're talking about pregnancy and postpartum, that is a particular very specific stage, then you focus on that, understand the needs of that stage and build your business around that. But then you have to figure out who's going to pay for it. How in India, the insurance ecosystem is terrible.
Yes.
It's
Pregnancy
full
and
of scams,
postpartum, we
actually.
need to build in the next phase. First, we have to solve these PCOS and stress, work-life balance, and stress management.
Yeah, but that's very vague. Those kinds of vague stuff don't get funded. And what you're saying, you will not be able to bootstrap either. I mean, what are you going to do? You have to start, if you want to bootstrap something, it has to start generating money right away, very quickly. You have to get to revenue really quickly. So what can you do that people are willing to pay for as soon as you possibly can get them to pay? If anything requires a year of free usage and then we will think maybe they will start paying a premium, that is not a bootstrappable venture. And given what I'm assessing, you're not a fundable situation either. So you will not be able to raise money. You're going to have to bootstrap, and the only thing that you can bootstrap is something that's going to start generating revenues right away. So this whole thing needs to be framed differently. You need to learn, Henil, how to build a business. And there's methodology of how to build a business. You can learn it from different places, and different places have different nuances. If you try to learn Y Combinator's methodology, that's going to be what Mark and I were talking about earlier. It is blitz scaling, raising huge amounts of money and blitz scaling. If you decide to learn the 1 million by 1 million methodology, we will teach you the bootstrapping methodology. That's what we believe in. And when to the extent that we raise financing, it's always bootstrap first, raise money later. The most successful company out of the 1 million by 1 million portfolio is a company that went on to raise over $250 million in financing, went public in NASDAQ at 10 billion plus valuation, but it was bootstrapped in the beginning. The early phase of that company, the company was in 1 million by 1 million for 3 years. We got it to paying customers before we raised the first $1 million from Accel. So that's bootstrap first, raise money later is the 1 million by 1 million methodology. That's how we operate. And I think you would benefit tremendously if you learn that methodology.
Okay, no problem.
Okay. All right. So folks, I'm going to take a quick pass through how to use 1 million by 1 million, and then we can go back to Q&A. I see other people in the room. If you have questions, you can start typing your questions in the public chat, or let Maureen know that you want to talk to me and she will put you in the panel and we can take questions from the public chat. So 1M is completely virtual and completely global. You can be anywhere in the world. I don't care if you're in Tennessee or Timbuktu, you can use 1M. So 1M1M.com is your starting point. Our full acceleration program is 1M Premium. You get this kind of sessions weekly, and you can participate in as many of those as you want, as long as you have an active subscription. The subscriptions expire after 1 year, but you can renew. We don't have any concept of graduating because, I've worked with billion-dollar companies. You can, if you need help, if you need strategy help, you can be in 1M and for as long as you want. People have been here for 3 years. Investor introductions are part of the premium program, but go read the investor introductions page on the website to understand. You have to be ready. Don't expect that you join the program and I'm going to send you to investors. This is not a router. 1M is not a router. You have to be ready. Everything that I have to decide that you're fundable before I send you to investors. And the truth of the matter is most companies come to us not ready. So we have to work on them to get them ready before we can send them to investors. We do have a very effective curriculum that follows this bootstrap first, raise money later strategy. And then I am a top influencer on LinkedIn. So if you need help with influencer marketing, we offer some degree of that through the program. What to expect from the basic program? Curriculum only. Henil, this may be valuable for you. You do need to learn the methodology. And 1M basic is an easy way to start learning the methodology. Just study the curriculum. So go to the website, see what you want to use, basic, premium. We do get requests for consulting. People are obsessed. Some people are obsessed about privacy and stealth and so on, and they want consulting. Fine, do that. Not a problem. We have roundtables every Thursday coming up. So if you're looking for a slot to pitch, Maureen will put you on the roster, and you're welcome to come and talk to me. If you book a slot, please do not do what these two people did today, of one not showing and the other one coming here and then dropping off before the pitch, because I know for a fact that Maureen turned down several people today. And that's really not fair to those who really want to pitch, that you waste a slot. We are almost invariably oversubscribed for these sessions. Those of you who have questions after this session about the program, you can contact Irina Patterson, irina@1mby1m.com. She can get on the phone with you, WhatsApp, Skype, whatever you want. Skype is gone, so WhatsApp, and whatever you want, she'll be able to chat with you. So does anybody else have questions? Please feel free to let us know if you want to ask questions, or start typing your questions in the public chat.
Salmana, can I ask directly?
Yes, of course, please.
Yeah, this one on roundtable, it's every Thursday are free, or we can book again if it is possible?
You cannot pitch again for free. If you want to continue to pitch and improve your, if you want to work with me on your venture, you have to be in the premium program.
I can buy a premium, because I took, as of now, I invested all of my fund in developing or designing or researching. So I can thought about your premium program. But as of now, if you are allowed to me to every Thursday or next,
you can attend every Thursday. You cannot pitch every Thursday. Your pitch slot is finished. This was your pitch slot. Free pitch slot you get once, and you've just used that up.
Okay, I get it. So I don't have any other free pitch.
Okay. Anybody else? Questions, comments? All right, folks, productive session. I hope, I know I gave you a bunch of feedbacks that are, not so easy to take, especially Henil. I've given you feedback that is not so easy to take. But I do believe that I gave you authentic, accurate feedback. So please consider it and make sure that you do not put yourself, see, if you pick an idea that is not a great idea to work on, and you spend 5-7 years of your life kind of spinning on that, you will be spinning in place. You will not be moving forward. And that's a terrible wastage of your talent, of your potential. This is not the way to run your life, and it's going to create lots of mental health problems and lots of problems in general. So when you decide what idea to commit your next 5, 7, 10 years of your life to, please be mindful. We have a very, very specific validation methodology that we teach in the program in 1M. I would like you to learn that methodology and really follow that methodology. And if your idea does not work, then discard it or morph it or pivot it, or, and all of that I can help you with. If you're part of the premium program, I will help you with. I'm going to be just as brutal as I was today with Henil in telling you, no, this is not going to work. You need to do this, this, this. So that's the way I operate. That's the way 1M1M operates. So if you want that kind of authentic, coaching, mentoring, consulting, whatever you want, you're very welcome to the 1M1M program. But if you're not open to feedback, and I've seen many entrepreneurs not open to feedback, they shut down and they run away, then please don't join 1M1M, because if you cannot absorb authentic feedback, we are not a program for you. Okay? All right, Mark, any comments? Anything you want to add?
No, I appreciate the candor of this call. I think it's too often we're afraid to speak the truth, and I don't think that's the way to care for people. So I really appreciate your candor, Shramana. It's great to be here.
All right, nice to meet you. We'll seek opportunities to work together in the future.
Indeed. Thanks for having me.
Bye. All right, folks, see you next time. Bye-bye.